Okay, good morning, everyone. So let me continue our new chapter about statement of cash flow. So let me review some of the concept from our previous class. For example, you already know how to prepare income statement, how to prepare the balance sheet, then how to prepare statement of stockholder equity. And today we are going to learn in detail about the cash flow statement. So what is cash flow statement? You can see. So cash flow statement will give you some information about cash receipts and the cash payments. So only cash related information. If you have any information, it is not related with cash, it is not the cash flow statement. So cash flow statement will give you information only related with cash receipt and cash payments. And we have two terminologies for cash receipt, one, and for cash payment, you can see that. So for cash receipt, we are going to use the term cash inflow. And cash payment is related with cash outflow. So what is the meaning here, cash inflow? So cash inflow means anyway, cash is inside your company. Maybe it is not your cash, okay? Maybe it is not your cash, but other people cash, but it is inside in your company. So when cash inside in your company, cash belongs to inside your company, we report them under cash inflow. Do you understand? Although it is not your cash, but the cash belongs to your company at this moment. So we should report them as cash inflow. And maybe some of your cash is not belongs to you, belongs to other people. That means it's not inside your company. If your cash is not inside in your company, it is outside. So we should report under cash outflow. Do you understand my point? Other people cash belongs to your company. You should report them as cash inflow, but your cash belongs to other people. We have to report them under cash outflow. So please pay more attention about the meaning of cash inflows and cash outflows. Okay, just think about cash. Cash inside your company, it is cash inflow. Cash is not with you, cash outflow. Then last class I explained that we have three activities of cash flow statements or cash flows, like operating activities, investing activities, and the financing activities. So we have these three activities and we have to report them separately. And every activities have different components, different cash inflows, and different cash outflows. Okay. So we know that operating activities are dealing with income statement items. And who are the income statement items? Revenues and expenses. Revenues and expenses are the income statement items that belongs to the operating activities. Then we also learned that investment and long-term assets belongs to investing activities. So who are the long-term asset here? Long-term asset means property, plant and equipment, land, building equipment. These are the long-term asset. It will go under investing activities. And we have financing activities like long-term liabilities and stockholders equity. So you have to be very careful to divide this classification. You cannot transfer operating activities to investing. You cannot transfer investing to financing. Okay. So you cannot transfer this kind of activities from one place to another place, and every activities we have cash inflow and the cash outflow. So investing activities, we have also cash inflow and cash outflow. Then financing activities, we have cash inflows and the cash outflows. So as it is very, very important to know that you cannot transfer one activities to another activities. So we should know very well who are the operating activities, who are the financing activities, and who are the investing activities with some examples. So it is important to know very well. Otherwise, if you transfer one activities to another activities, you will have a mistake and you will lose your grade. Now, let's see in detail about the operating activities. So operating activities are the income statement items. And who are the income statement items? Revenues and expenses. Now let's see cash inflow. First example about cash inflow, that you sell your goods or you sell your service. And when you sell your goods and you sell your service, you have to make sure that they are related with cash. Sometimes you sell goods or sometimes you sell service not for cash. Okay. Today you sell your goods, maybe you will receive cash in future. But today, according to the cash flow statement, today you cannot record it as cash inflow. So cash inflow, you have to remember that I told you that anyway, cash came to your company. Okay, whenever you have received this cash, then you should record it under the cash flow statement. So today we sell our goods, today we sell our service, and today we receive cash. Today, okay, today we receive cash, then we can record this cash under operating activities. Why operating activities? Because sales is the revenue, service is the revenue. So they should go under operating activities, and you have to make sure that you receive cash. If you do not receive cash, you have to ignore it. If you receive interest or if you receive dividend, it is also your revenue. Do you understand? You receive interest, it is your revenue. You receive dividend, it is also your revenue. And if you receive cash today, okay, if you receive cash today, you have to record it under cash flow statement under operating activities. So these two examples are cash inflows for operating activities, and these examples are related with revenue. And the revenue should be connected with cash. Then we are going to see cash outflow. That means cash is not with you, cash goes to other people. And who are the examples? This example should be related with expenses, because we are talking about operating activities. First example, to suppliers for inventory. So you are going to pay cash to suppliers. Why you are going to pay cash to the suppliers? Because you buy inventory from them. And this inventory is connected with cost of goods sold, because we are talking about operating activities. So although inventory is asset, but at this moment, we are talking about the cost of goods sold, because inventory converted into cost of goods sold. So we have to pay cash to the suppliers for inventory, and we are considering here cost of goods sold. It is the expense item. So if we pay them cash, then our cash is going to decrease. So cash outflow. Then our company pay cash for the salaries and wages to the employee. Okay. So if you paid cash for salaries expense or for wages expense, it means that cash outflow. For example, today I already give you lecture, and today university is not going to give me any cash. So today university cannot record it as their expense. Okay. So we should record cash outflow if company pays salary or wage to the employees. Then to pay tax to the government. Okay, if our university paid income tax to the government today, we have to record it as cash outflow today. So this is the cash outflow for paying income tax to the government. Then if we pay interest, okay, if we pay interest, it is our interest expense, and if we paid cash, cash outflow. So if you receive interest, you can see that here under cash inflow. If you receive interest, it is your revenue, and if you pay interest, it is your expense. And here we pay cash, so cash outflow. So any other expenses, if you paid cash, then cash outflow. So when you will read the question, you have to be very careful about whether you receive cash or whether you pay cash. So if you do not receive cash, it is not cash flow statement. If you do not pay cash, it is not cash flow statement. So this is something overview about operating activities. Then let's see the investing activities. So look at the example of investing activities. So we know that investing activities are related with investment, right? Related with investment and long-term asset. So let's see the examples of investment. Try to understand this diagram. Example 1 said that company X is your company at this moment. So you have a company, it is called company X. Now think that you have a lot of cash. You have a lot of cash. You run your business very well. You have a lot of cash. So what you can do with your cash? If you do not invest this cash, you don't have more income in future. So what you can do? You can buy some bond, or you can buy some stock from another company. And it is something like company Y. So company Y is another company, but your company at this moment is X. You have a lot of money. Now what you can do? You can go to the bond market. You can go to the stock market, and you can buy bond from company Y, and you can buy stock from company Y. And in accounting, this transaction is called investment. In accounting, altogether, this event is called your investment, because you are going to invest your money to another company, right? So you are going to invest your money to another company. And when you buy, you know that when you buy another company's bond, then you have to pay cash. That means cash outflow. When you buy another company's stock, you have to pay cash outflow. What is the summary here? Summary here is, if you buy investment, you have to pay cash, right? And this is the example of what is the meaning of investment. So whenever you buy investment, you have to pay cash outflow. Now, a few days later, you can sell your investment. So today you have enough money, you can buy investment, but in future, if you need your money back, okay, if you need your money back, you can sell this investment anytime. You can sell this investment. And when you sell this investment, okay, when you sell this investment, you are going to receive cash back, right? You can receive the cash back, so it is cash inflow. So this is the example of investment. This is the example of investment. You buy investment, you pay cash, then you sell investment, you get your money back. Now we have another example for investment, is called property, plant and equipment. So let's see example 3. Again, X is your company. So your company purchase or buy property, plant, and equipment. So what is the example of property, plant, or equipment here? Your company can buy a land, your company can buy an equipment, your company can buy a building, something like this. So when you buy it, and if you pay them cash, immediately, then your cash decrease, cash outflow. Now maybe few days later you need some money. So what you can do? You can sell one land, you can sell one building, you can sell some equipment, and you can get some cash. So example 4 said that you sell your property, plant, and equipment, and you can get some money back, cash inflow. So these are the overview of investing activities. So this diagram explains how investment activities are related with cash inflows and cash outflows. So I can convert this diagram to the sentence like this. We are talking about investing activities and it deals with changes in investment. So what is the meaning of changes in investment and long-term asset? That means your investment is going to change. If you buy investment, your investment increase, right? If you sell investment, your investment decrease. So it is changing. Then if you buy property, plant, and equipment, it is increasing, right? If you sell property, plant, and equipment, it is decreasing. And as we are talking about cash flow, this increase and decrease should be connected with cash. So cash inflows, I told you that when you sell property, plant, and equipment, because it is your long-term asset, when you sell it, if you receive cash, so cash inflow. So you have to read the question very carefully. That question will tell you that your company sell a land, or your company sell building, or your company sell equipment. Then you have to be careful that whether it is related with cash or not. So if it is related with cash, then cash inflow. If it is not related with cash, it is not cash flow statement. Do you understand? So you have to read the question carefully. Then you sell your investment. And of course, if you receive cash, then cash inflows. Then you collect some principal amount from other entities. For example, previous 2 years before, you give me some cash as a loan. Okay. Now today, I return back your money. So when I return back your money, you are going to receive your principal amount. That means your cash is going to increase today. Today, your cash is increased. Why your cash increased? Because I return back your money, right? So I can give you 2 types of money. Because as you give me loan, right? As you give me loan, I have to return back your money. Plus, I have to give you some interest expense. Can you remember? Why you give me some loan? Because you need more money. You give me $10,000. So I return back you $10,000 and I also give you $1,000 interest. Now $10,000 is called the principal amount. So principal amount of $10,000 will go to the investing activities, because before you give me money, it means that you invest your money to me, right? So when I give you principal amount, it is investing activities, and when I will give you interest, it is your interest revenue. Do you understand? I give you 2 types of money. One is your principal amount, another is your interest. So you receive 2 types of money. Interest should be recorded as revenue. That means operating activities. And principal amount is reported as investing activities. Now look at the cash outflow. When you buy property, plant, and equipment, you paid cash. Your cash decrease, cash outflow. Then when you buy your investment, you paid cash, cash outflow. And when you give me some loan, your cash will decrease. So make loans to other people. You give me some loan. So your cash decrease. So today you give me loan, your cash decrease, but when I return back your money, you receive cash, your cash increase. So this is the cash inflows and outflows for investing activities. And you should know that investing activities is only deal with investment and long-term asset, not revenue, not expense. Now financing activities. Again, you can see this diagram. First example, here company X is your company. Now, what is the meaning of financing? Financing means your company do not have enough money. So your company is going to collect the money. From whom? From other people. Okay. So if you have a lot of money, you can invest your money. But if you don't have enough money, you can collect this money from some other sources. So that's why it is called financing. Your company is going to finance. Your company is going to collect the money sometimes. Look at the example. Company X now issue or sell. Your company is going to sell bond, or your company can sell some stock. Do you understand? Your company can sell some bond, or your company can sell some stock. And by doing so, they can easily collect money. So cash inflows. So these examples said that your company do not have cash, but how can you collect the cash? Go to the bond market, sell the bond and collect the cash. Go to the stock market, sell the stock and collect the cash. So cash inflows, right? Now, if you remember your previous two chapters, we talk about long-term liability and accounting for corporation. If you remember, two terminology is about buy back the bond and buy back the treasury stock. Can you remember? So today you sell bond, but in future you may buy back the bond. So look at example 2. Your company don't want to continue bond, don't want to continue stock. So your company can buy back some bond, or your company can buy back the treasury stock. Can you remember? So bond is related with long-term liability chapter, and treasury stock is related with accounting for corporation chapter. We learned this concept already, right? So when we buy back treasury stock, we have to pay them money back, right? So when we buy back the bond, we have to pay back the money, right? So buy back the bond, pay cash outflow, then buy back the treasury stock, pay cash outflow. Do you understand? Now you know that if you buy bond, you have to pay them interest, right? Where should we transfer this interest? You buy bond, you sell bond. You sell bond and you collect money from other people, and you have to give them interest expense. Where should you transfer this interest expense? Interest expense should go to the operating activities, right? So interest expense should go to the operating activities. But if you sell stock, you have to give them dividend. You have to give them dividend. Dividend will go under financing activities. Do you understand? I repeat again, if you sell bond, you have to pay interest, and interest will go to the operating activities because it is expense. But you pay dividend, it is not the expense. Do you understand? You pay dividend, it is not the expense. Why? Because what is the definition of dividend? Dividend means you are going to give them cash from net income. Net income is their money, right? Net income is the stockholders' money. So you give them some cash from the net income. So stockholders' equity will decrease because of this cash decrease. It is not related with revenue, it is not related with expense. So when you pay dividend, it means that you pay their net income, right? You pay their net income, and it is net income is related with equity because net income goes to the shareholder. So when you pay dividend, it is related with financing activities, cash outflow. So if you receive dividend, If you receive dividend, it is your revenue. Your company receive dividend, it is the revenue. But when your company pay dividend, it means that your company pay dividend from the net income. So stockholders' equity will decrease, and it is the financing activities. So let's see the sentence from this diagram. Again, financing activities means changes long-term liability. That means long-term liability increase or decrease. You buy bond, your liability increase, right? Then you buy back the bond. No, sorry, let me say again. When you sell bond, your liability increase, right? Because you sell your bond, your liability increase. But when you buy back the bond, your liability decrease. So changing. Like a stockholder's equity. When you sell a stock, common stock or preferred stock, your stockholders' equity will increase. But if you buy back treasury stock, okay, your stockholders' equity will decrease. So this is called changes long-term liabilities and changes stockholders' equity. So let's see cash inflows. That I already told you that you can sell common stock, you can sell preferred stock, okay, and you may collect cash from the stock market. So your cash increase. Then you can go to the bond market, you can sell your bond, or you can sell note, and you can receive cash increase. Then what about the cash outflows? When we pay dividend, it means that we pay dividend from their equity, we pay dividend from their net income. So it is related with financing. So this transaction will decrease the equity. Can you remember our long-term liability chapter? I told you the dividend decrease the equity. So when you sell a stock, your equity increase. When you give them dividend, equity decrease. When you give them money back for buy back the bond or buy back the treasury stock. So you buy back bond, you buy back treasury stock, you pay them cash decrease. Yes. So these are the examples of financing activities. Now let's see the summary. We have operating activities, we have investing activities, and we have financing activities. Now I put some examples here. And in your exam question, you also have this kind of information. When you read a question, okay, you will find that you have revenues, you have expense, you have current asset, you have long-term investment, you have long-term liabilities, you have long-term asset, you have common stock, you have preferred stock, you have dividend. So you will find this information in the question. But when we are going to solve this, we have to make them classification, right? We have to make them classification. Some items will go to the operating activities, some items will go to the investing, and some item will go to the financing activities. And if you mix them together, okay, if you don't know which one is which activities, you have a mistake and you will lose your grade. So we know that based on my explanation already, we know that revenues is the operating activities, expenses are the operating activities, then long-term investment. That means your company has a lot of money, your company can buy bond or stock from another company, it is called investment, and you pay cash, investing activities. Long-term asset, property, plant, and equipment. Property, plant, and equipment are the investing activities. Then long-term liabilities like bond, your company sell bond, it is long-term liability, financing activities. Your company sells stock, financing activities. Your company pay dividend, financing activities. So this is some examples, not all. Okay, some examples. Now we have two remaining, current assets and current liabilities. Who are them actually? So I haven't tell you about the current asset and the current liabilities. So you should know what is the meaning of current asset, what is the meaning of current liabilities from your previous course. So what is the meaning of current asset? Current asset means this kind of asset you can use for less than 1 year. Or you can say another way, you have some asset that are going to convert it into cash within 1 year. Then liability means you are liable to pay this money within 1 year, right? So where should we transfer this current asset? Where should we transfer the current liability? Whether it is operating, whether it is investing, whether it is financing. So I haven't tell you yet, right? About the current asset and current liability. So the answer is they will go, that means current asset will go under operating activities, current liabilities will go under operating activities. The question is why? Why current assets are related with operating? Because we know that operating means revenue and expense, right? Operating means revenues and expense. So why current asset and current liabilities goes to revenue and expense? Why? The reason is, I will give you solution example very soon. The theory is current asset indirectly related with revenue account, and current liabilities are indirectly related with expense account. This is the accounting concept you should know. Okay, every current assets are indirectly related with revenues account, and every current liabilities are indirectly related with expense account. So as they are indirectly related with revenue and expense, it should go under operating activity. So let me explain one or two examples. So think about the journal entry. January 1st, we have a transition. Sell goods $50,000 on credit or on account. So you sell your goods. Total value is $50,000, but it is on credit or on account. So what is the journal entry here? So you sell your goods. Have you received cash? This sales is related with cash. What is the meaning of on credit? What is the meaning of on account? Have you learned this from your principles of accounting course? You learned this, right? So it means that you sell your goods but not yet receive cash. So what is the journal? Journal is accounts receivable debit. Accounts receivable debit, $50,000. And you have to record sales revenue credit. Very good. Sales revenue credit, $50,000. Right? This is happen. When this happened? This happened in January 1st to January 1st. So here, this is current asset. Right? This is called the current asset. And sales revenue is the revenue, right? Revenue. And we know that revenue means operating activities. We know that revenue means operating activities, right? But here, we cannot report it under cash flow statement. So January 1, this transaction, we cannot report it under under cash flow statement. Why? Because it is not related with cash, right? It is not related with cash. Although sales is our revenue, but we cannot report it under operating activities because it is not related with cash. So look at another journal entry. January 15. Cash collected from accounts receivable in accounts receivable $50,000. So now another day came, and you collect this $50,000. Okay, and what is the journal entry? Journal entry is cash debit, $50,000. And what is credit here? Accounts receivable. Accounts receivable credit $50,000. Now, as it is related with cash, you can see that transaction 15, January 15, related with cash, right? So it is cash flow statement. Do you understand? Now, my question is, where should you transfer this cash? We have operating activities, we have investing activities, and we have financing activities, right? So we have to transfer this money to a right place. Can you remember? We have operating, investing, and financing, right? So you receive cash today, January 15, you receive cash. Where should you transfer this money? Operating, investing, or financing? According to this example, this cash is going to add, okay? This cash is going to add with operating activities. Why this cash is going to operating activities? Because this cash is connected with accounts receivable, right? And this accounts receivable is connected with indirectly which one? Sales revenue. Do you understand? So accounts receivable is current asset. Look at here. Accounts receivable is current asset. And we receive cash from accounts receivable. We receive cash from accounts receivable. So this is current asset. And it is related with, this current asset is related with revenue. Do you understand? So we receive cash from accounts receivable. So accounts receivable is current asset, we know that. So here, if we go back here, accounts receivable is current asset. Okay, accounts receivable is current asset. And this current asset we transfer where? We transfer operating. And why operating? Because this current asset is related with revenue. Do you understand? So this is the reason. This is the reason current asset is indirectly related with revenue. So this is the example. Clear? So look at another example. Look at another example. That means current liability. I told you that current liabilities are related with expense, right? Indirectly. How? We can see. January or December 31st, 2022, for example. December 31st, 2022, something happened. Accrued income tax $5,000. Accrued income tax expense. So accrued income tax expense $5,000. What is the meaning of this transaction? What is the meaning of the word accrued? So we already know that income tax is our expense, right? Income tax is our expense. Two information here. Income tax expense, it is accrued, right? And when? It is December 31st, 2022 date. in accrued income tax expense $5,000. What is the meaning? What is the meaning of this transaction? The meaning is income tax is our expense, right? Income tax is our expense, but cash is not yet paid to the government. This is the meaning of this transaction. Income tax is already our expense, right? Income tax is our expense, but we have not yet paid cash. We have not yet paid cash to the government. So what is the journal for this? What is the journal for this? The journal is income tax expense debit $5,000. And what is credit here? What is credit? Income tax payable. Payable credit. $5,000. Payable means, what is the meaning of payable? Payable means cash to be paid in future, right? Cash to be paid in future. So this is called current liability. This is the current liability. You understand? This is the current liability, and income tax expense is our expense. And we know that expense is operating activities. Do you understand here? So can we record it under cash flow statement, although it is operating activities? All the expense is our operating activities. Can we report them under operating activities cash flow statement? No, right? Why no? Because it is not related with cash. It is all the expense, but not related with cash. Now look at another date. June 15, 2023. Another day, another year. Our company paid cash for income tax payable. $5,000. So company paid cash to the government for income tax payable. So this is another day. So what is the journal here? Journal here is you pay cash, right? You pay cash, cash should be credit. Cash should be credit. So cash credit. Cash credit. How much cash you paid? You paid cash $5,000. And what is debit? What is debit? Income tax payable. Yes. Income tax payable debit. $5,000. Now these transactions, December 3rd, June 15, these transactions we should report under cash flow statement. Why? Because something is related with cash, right? We have cash account. Now cash increase or decrease? Here our cash decrease, right? Our cash decrease. Cash decrease means cash inflow or outflow? Cash outflow, right? Cash outflow. So as it is cash outflow, we should record it under cash flow statement. Now question is where? Where we will minus this account? Because this cash is going to decrease, deduct from which activities? Operating, investing, or financing. So it should be operating, right? Why operating? Why we pay cash? We pay cash because of income tax expense, right? Because of income tax expense. So this is related with operating activities. So here, I repeat again, every current asset, indirect related with revenue. So we transfer the current asset related cash where we transfer current asset related cash to the operating activities. Every current liability is indirectly related with expense. So any cash related with current liabilities should goes under operating activities. Okay, clear? So that's why it is called, I mean, current asset and current liabilities are indirectly connected with revenues and expense. And as they are connected with revenue and expense, it is operating activities. I think you understand. Now look at this example. Look at this example. Look at the first journal. Your company buy some asset, but your company do not have any cash. I told you that your company can buy property, plant, and equipment, right? Your company can buy property, plant, and equipment. So here your company buy property, plant, and equipment means your company buy land. But according to this example, your company do not have enough cash, but they want a land. So they buy a land, but they did not pay any cash. They give them common stock. Okay. So the journal is land debit and the common stock credit. Do you understand? Look at another transactions. Convert bond into common stock. Bond is a liability and common stock is the capital. So bond is going to convert into a common stock. That means liability is going to decrease and capital is going to increase. Do you understand? One converted into another format. So bond is a liability. It is going to convert into a common stock. I believe you learned it from your Principles of Accounting 1 course. So when bond convert into common stock, your liability will decrease, liability debit, bonds payable debit, and it's going to convert a common stock, capital increase credit. Look at another transaction 3 related with transaction 1, that you buy asset, but you do not have any cash, you give them a bond. So you buy equipment and you don't have any cash, you give them your bond, so bonds payable credit. Another similar examples, exchange of plant asset. So you buy equipment, you don't have cash, you give them your land. Now, these 4 transactions, in the exam question, I will give you one item from here. You will find one question from these 4 items. Now, what is the problem with these 4 items with the cash flow statement? You can see that land, building, equipment are the investing activities, right? We have land, we have equipment, we have another land, we have another equipment. They are the investing activities. Then we have common stock, financing activities, bonds payable, financing activities. So we know that they are investing and financing activities, but we cannot report them in the cash flow statement. Why? Why you cannot report them under the financial cash flow statement? Because they are not related with cash. I told you that you buy property, plant, and equipment, and if you pay cash, then it is investing activities. If you do not pay cash, it is not investing activities. Okay. So if although they are investing activities or financing activities, but we cannot report them under cash flow statement because they are not related with cash. And your exam question will have at least one. Okay. So if you find this transaction, you have to ignore them. You read this question and ignore it. What is the meaning of ignoring? Ignoring means you don't want, you no need to report this under cash flow statement. Just ignore it because it is not cash flow statement. So look at the note. Companies report non-cash activities separately. Okay, if you have any non-cash activities, just report them separately, but not under cash flow statement. Okay. Now, I told you that when we solve the question, we have to classify our cash inflows and cash outflows for three groups: operating activities, investing activities, and financing activities. And you cannot transfer, I told you that you cannot transfer operating activities to financing. You cannot transfer financing to investing. You should report them separately and accurately if you want to get full marks. Okay, so that's why last class and this class I explained again and again who are the operating activities, who are the investing activities, and who are the financing activities. I spent 2 classes, right, to give you knowledge about who are the operating, what is their examples, who are the investing, what is their examples, who are the financing, what is their examples, and when it will go under cash flow, whether it is related with cash or not. So I already explained a lot of time to give you the overview about these 3 concepts. Now you can see that investing and financing activities do not have any method. So when you solve investing activities or financing activities, you do not have any method. But when we are going to solve operating activities, then we have 2 methods. One is called direct method, another is called indirect method. And for your syllabus, we have only one method, is indirect method. So if you are the accounting major and if you learned intermediate accounting, then you will learn the direct method at the time. So according to our syllabus, we are going to learn only indirect method. Okay. And this is the format that I will explain when I will solve a question. We have to follow this format accurately. Okay, we have to follow first operating activities, then investing activities, then financing activities. Then we should record some increase or decrease cash. We have to report what was the beginning cash, what was the ending cash, something like this. So when I will solve the question, I will explain the format later on. Now, these concepts are very, very important for the cash flow statement. So I believe that in your principles of accounting 1, you already learned the difference between cash basis of accounting and accrual basis of accounting. These 2 concepts are very, very important concepts in accounting. So as you are learning accounting, you should know what is the related and what is the differences between cash basis and accrual basis. Now, when we record journal entries, when we prepare income statement, when we prepare balance sheet, we follow accrual basis. I repeat again, try to understand. When we record journal entry, when we prepare income statement, when we prepare balance sheet, we use accrual basis of accounting. But when we prepare cash flow statement, okay, we only consider cash basis of accounting. Do you understand? Now, what we have to do? When we prepare cash flow statement, we have to eliminate all accrual basis of accounting, and we should convert it to the cash basis of accounting. That means that accrual basis of accounting is going to convert as a cash basis of accounting. Why we have to convert accrual to cash? Because we are preparing cash flow statement. So you have to know what is the meaning of cash basis and what is the meaning of accrual basis. Now I'm going to show you the definition and examples, although you already learned it in your previous course. I just repeat again. So this is the definition of cash basis. Cash basis said that we have to record revenue when we receive cash, and we have to record expense when we paid cash. Do you understand? For example, today I already give you my lecture, right? And this is called salaries expense. For whom? For the university. Because university gave me salary. Why university give me salary? Because I give you service, right? So today I provide my lecture. Today university record expense or not. It depends on cash basis or accrual basis. If our university follow cash basis, today they are not going to record expense. Because why today they are not going to record expense? Because today our university is not going to give me salary, cash. This is called cash basis. But if our university follow accrual basis, our university should record salaries expense today. So look at the accrual basis. Accrual basis said that revenues and expenses are recorded when they are incurred. So revenues are recorded when they are earned, and expenses are recorded when they are incurred. Do you understand? That means that accrual basis means that you record revenue whether you receive cash or not. You provide your service, right? That means that revenue already earned. You receive cash or you do not receive cash, it doesn't matter. You have to record revenue. So what about expense? Expense already incurred. Today, we already use our electricity. Today, we already take this class for 1 hour and we already use this electricity, right? So it is our expense according to accrual basis. But cash basis said that today it is not our expense because we have not yet paid any cash. So if we go back here, if we go back to the previous example, look at this example here. January 1st and January 15. January 1st and January 15. According to accrual basis, January 1st is the revenue, right? January 1st is the revenue. Why? Why? Because we provide service or we sell our goods. But according to cash basis, January 1st is not the revenue. Do you understand? But according to cash basis, when company will record revenue? Company will record revenue on January 15. Why? Because company received cash on January 15. Do you understand? Company received cash on January 15. So according, if I make the reference here, this is accrual basis revenue. Although company did not receive cash, company record is revenue. But cash basis said that. So January 1st, this is January 1st. Cash basis do not record revenue. According to the cash basis, January 1st is not the revenue. According to the cash basis. But according to the accrual basis, it is revenue. Do you understand? So January 15 came. Okay, January 15 came, company received cash. So January 15 cash basis will record revenue. January 15 cash basis will record revenue. Why? Because January 15 company received cash. Do you understand? Look at another example. Expense. Here, December 31st, 2022, we record income tax expense. Income tax already expense recorded, right? This is accrual basis. Accrual basis. Record expense. But at that day, I mean December 31st, 2022, cash basis do not record it expense. Do you understand? At cash basis, December 31st is not expense. Do not record expense. Why? Because it is not related with cash. But when June 15 came, so June 15, cash basis, record it as expense. Why cash basis recorded as expense? Now they paid cash. So if we go here, if we go to the definition, look at here, cash basis, record revenue. When they record revenue? If they receive cash, right? Cash basis record expense. When record expense? If they paid cash. But what about accrual basis? Accrual basis record revenue if they receive cash or if they do not receive cash. Okay, you provide service, you have to record revenue. It is related with cash or not, doesn't matter. You provide service, record revenue. Record expense, when it is already incurred, you pay cash or not, record it expense. So look at this diagram. Look at this diagram. This is the diagram for cash basis. I told you that according to cash basis, you can only record revenue. When you will record revenue, if you receive cash. If you do not receive cash, don't record revenue. Okay. Then according to accrual basis, record expense. When record expense? If you pay cash. If you do not pay cash, don't record expense. Clear? Now look at the accrual basis. This is the diagram for accrual basis. Accrual basis said that record revenue. Record revenue when you receive cash, you can record revenue. If you do not receive cash, you can also record revenue. Okay? Do you understand? Record revenue when you receive cash. Record revenue if you do not receive cash, also record revenue. Record expense if it is incurred. You paid cash or not. If you paid cash, record expense. If you do not pay cash, also record expense. Now, if you understand these two diagrams, when we use this indirect method, what is the meaning of? I told you that we are going to use this indirect method. What is the meaning of indirect method? I can write here. Indirect method means convert accrual basis revenue and expense to the cash basis revenue and expense. Why? Because you know that the question will give you income statement. Okay, question will give you income statement, question will give you balance sheet, and income statement and balance sheet are prepared based on accrual basis. Okay, income statement and balance sheet are prepared based on accrual basis. But when we are going to prepare cash flow statement, we have to convert it. We have to convert cash basis of accrual basis of accounting to cash basis of revenue and expense. This is called indirect method. Indirect method said that we have income statement, we have balance sheet, and they are prepared based on accrual basis. But as we are preparing income cash flow statement, we have to convert accrual basis to the cash basis. So for example, this is accrual basis. How to convert it into cash basis from this diagram? Can you understand? This is accrual basis of accounting, right? And indirect method said that this accrual basis should be converted. This accrual basis, okay? This accrual, I can type here. This accrual basis should be become as cash basis. Now, how you can change the diagram to make it cash basis? How can you make it? Just delete this part. delete this part. If you delete this part, you can see that accrual basis converted into cash basis, right? Look, all transactions are now related with cash. We deleted the cash, we deleted the transactions that are not related with cash, right? So this is called indirect method actually. This is called indirect method. That means that, look at this diagram. So we have accrual basis expense. You can see that we have accrual basis expense and we have accrual basis revenue, right? This is given in the question. Question will give you this information. Question will give you this accrual basis revenue, this accrual basis expense. Now this is the question give it to you. Now we have to convert it to the cash basis. We have to convert it to the cash basis. Do you understand? Question give us accrual basis, revenue and expense. We have to convert it to the cash basis. How? I already show you. We have to eliminate something. We have to eliminate non-cash revenue and gains. We have to eliminate non-cash. Okay, we have to eliminate non-cash expenses and losses. So non-cash items going to delete. So if you delete non-cash revenues, if you delete non-cash expenses, you can get cash basis net income. Now the question is how to delete them. It is not easy to delete. Okay, it is not easy just to delete something. To do this kind of activities, we have to follow some steps. These are the steps. These are the steps that will tell you how to convert accrual basis of net income to the cash basis of net income. So you remember that operating activities related with revenues, expense, right? Operating activities related with revenue, expense, and current asset and current liability. Can you remember these 4 items? I already explained. Revenue is the operating activities, expense is the operating activities, then current asset indirectly related with operating activities, current liabilities indirectly related with operating activities. So if we do this kind of plus and minus, okay, if we do this kind of plus and minus, it indirectly eliminate all non-cash revenue and expense and give you only cash revenue and expense. So this class I am not going to explain this table. Next class I will explain the table. But you can see the table. This table is about revenue. This table is about expense. This table is about current asset. This table is about current liabilities, right? Because these 4 items are related with operating activities directly or indirectly. Anyway, so next class I will tell you why some items are plus, why some items are minus, and how it converted accrual basis to the cash basis. Okay, so that's all for today. Thank you very much.